Hello everyone and hello traders. Welcome back to Trust Whales. Today we are diving into the Ethereum chart with a clear purpose to uncover the next trend for this coin. I'm excited to guide you through the intricate details of the market. So let's get started and see what clues the chart reveals. In a previous video, I took a deep dive into Bitcoin where I explained all concepts. That analysis sets the groundwork for today's insights, so if you haven't seen it yet, I highly recommend checking it out. Now, shifting back to Ethereum, I want to focus first on the current supply and demand zones. Right here on the chart, notice how the price action creates distinct areas of support and resistance. Shortly, you'll see a sudden, sharp fall, a movement that carries extra context and clues about what could be coming next. Now here, observe this large shadow I'm marking on the chart. I'll start by emphasizing its size, as it tells a story of market volatility. Then I draw a box around it to highlight what I consider a crucial liquidity zone. This zone is where many orders are clustered and its behavior can signal upcoming market moves. The way price interacts within this area often helps us gauge potential reversals or continuations, offering us a tactical advantage in our trading decisions. These large areas that are clear after spike candles reveals gaps for traders. Imagine you can predict most of traders' actions and then boom, you can find where the market will trap all of them and you should avoid acting on them. In here, most stop losses will be filled and millions will be collected from all traders. Next, according to my own experience in trading, I'm measuring beside that dramatic sharp fall candle. The center of this spike is especially important. It tends to act as a strong reaction point, forming what I consider a reliable demand zone or even a support area. Speaking from my own experience, when this line holds, it often stabilizes the market. However, if this level is breached, it can trigger a liquidity void, setting the stage for massive losses for many traders caught off guard. So, those who opened long-term positions will miss their profit due to escaping spike features. They are so important because gaps always cause trouble, and you should avoid ignoring them. Here, the trend is projected to dip into the liquidity zone. Typically, the price falls, triggering stop losses, and then experiences a swift rebound. This behavior is key to understanding market reversals and help us plan our entries and exits more effectively. Now let's revisit the demand zone I discussed in our earlier analysis. As the price action evolves, I am now transitioning this previously identified support area into a new resistance zone. This shift reflects a change in market sentiment, a transformation that can open up fresh trading opportunities as the balance between buyers and sellers adjusts. Now pay attention to chart and let's see how it works for us. And after all of these, at this point, I'm highlighting a clear break of structure on the chart, a phenomenon often referred to as a BOS. This break signals that the underlying market dynamics are shifting. Such a structural change is critical for us because it may indicate the beginning of a new trend, alerting us to adjust our strategies accordingly and stay ahead of potential reversals. Break of structure is more valid on low time frames, but here we are using it on 4-hour time frame, so I guess that's okay. You might be curious why I approach chart analysis in this detailed way. My method combines price action with historical order flow and liquidity zones to create a comprehensive picture of market behavior. This blend of technical insights allows us to better manage risks and seize opportunities by understanding both the current momentum and the market's past structure. Now taking a brief look at some key historical features on the chart, even though these elements date back 2 weeks or even a month, they represent essential orders and zones that have stood the last test of time, providing critical context to current price. And yes, here you can see a dodgy candle, an important signal that the market is a test of indecision. This candle suggests that buyers and sellers are at a temporary standstill. To keep a close eye on this level, I've drawn a horizontal line, making it as an area of caution where the market might be searching for direction. So I can move better in current timeline. And then next, I am diagnosing an order block, sometimes referred to as a block order. This is a zone where significant buying or selling has occurred previously, and it continues to influence current price movement. I introduced this concept by placing another horizontal line on the chart, which helps us track how these historical orders impact today's trading dynamics. And as we continue, notice how the current trends are reacting strongly to the two horizontal lines we have drawn. Their influence is clear. The price repeatedly respects these levels, validating their importance. I label both lines as order block because they represent key areas where institutional orders have to historically been placed. This consistency gives us confidence in using these markers to predict future market behavior and to plan our trades more logically. And also, these two lines can give us hints to our exact entry point or even stop loss or even our TP. So, paying attention to history is not bad at all. Let's pause to review our analysis so far. We have examined significant supply and demand zones, identified liquidity clusters, and measured critical reaction points. All these observations come together to form a clearer picture of why the market moves as it does. This comprehensive analysis helps us understand the underlying forces at play and guides our trading decisions with a well-informed perspective. So, by gathering all these features and not by only making charts crowded with lines, we can open a safe position in everywhere. So, based on the insights from our first order block and observing a weak shadow breaking below it, I am taking a short position at this moment. The evidence suggests that the downward momentum is gaining strength, and even though the signal might appear subtle at first, it aligns with the overall market structure. This trade is a calculated decision rooted in careful observation and solid technical reasoning. But it is noteworthy that every trade should not lead to profit. Even a well-detailed analysis will lead to failure, and it's inevitable. So, before we conclude this segment, I'm also scanning the Bitcoin chart to find a corresponding liquidity zone that supports our analysis here. It's interesting to note that Ethereum is currently sticking within a defined range, which might also be interpreted as a fair value gap. This cross-verification between assets further strengthens our overall analysis. Finally, let's shift our focus to a broader indicator view by zooming in on the RSI and closely examining the EMA, although the gaps we see on these indicators aren't overwhelmingly pronounced. They still provide valuable context for our position. In my view, they suggest that we can safely hold our trade for at least the first half of its anticipated move. As we wrap up, I want to thank you for joining me on this deep dive into Ethereum's chart. If you found these insights valuable, please hit the like button, subscribe, and share your thoughts in the comments. Until the next time, keep reading charts like a whale, and happy trading, guys!